Okay, can you guys hear us out there now? We're having all sorts of telephone snafus here today. Okay, we're good. We're doing this via cell phone, no less here today. So let's go back. Let's just start over at the beginning and let's roll from there then. So I'm going to give it to Joe. We're going to be passing the phone back and forth here, so bear with us.
Excuse us, folks, for our technical difficulties here this morning. We thought we were speaking with everybody, but thanks to those who answered my question, no, you could not hear us. Now you should be able to hear us that we've called in by telephone. We're here to give you a recap on what is a very exciting, it seems, USDA report. This report is so important because it includes the USDA's first look at estimates for the 2016-17 crops, the new crops. And what we saw today was really something that was unexpected in that the corn and soybean numbers, soybeans in particular, ending stocks for the next year came in well below trade estimates. You'll see that in the screen ahead. We have the USDA May estimates. Those are today's on your left-hand side compared to the average estimate and also the range of estimates. We did have a cut to soybeans on the old crop. You can see 26 million bushels more than anticipated. And then for the most important number, the real reason we had beans jump up considerably after the report, a number that went from, a new number at 305 million bushels for 16-17 ending stocks. That's compared to analyst expectations of something closer to 405 million bushels. But there was a wide range of expectations. You can see that on the range of estimates column there. The real thing here, I'm going to ask Dale again a question I asked him a little bit ago. It wasn't a matter necessarily of supply. We knew that the USDA was all but guaranteed to bring in the March 31 acres estimates. We wondered if they would set production and then maybe massage yield a little bit, but no, they've used, it seems, trendline yields. Instead, we've got our adjustments made to demand, and the demand numbers are impressive.
But yeah, like Joe said, it really was the demand side they chose to make the adjustments. You never know when you get these first initial S&Ds from the USDA as to realistically how they're going to manage a situation. I think there was probably some feeling inside the department, like some other people out in the trade, that the large corn acreage in particular maybe could shrink a little bit. We had problems in the south, and we've had the corn-soybean ratio do a dramatic flip. We were back here at the end of March about 2.3 or so to 1, as I remember, and today we're sitting here at 2.74, and it's been going up steadily ever since we had that March 31 planting report. So, it really kind of always is a question on how they choose to do things, but when you look at what they did and some of the things, when you look at corn and the big demand numbers they plugged into new crop, when you look at beans and really what I'd call generous demand numbers they had plugged into new crop here at this point, it really does look like they chose to make a shift in terms of the demand and maybe come along later and make some changes there, or at least massage some changes there. Got to be a little careful. There's been also this long history in the soybean export number per se that they've tended to discount or underestimate, I guess would be a better word, soybean exports on those initial S&D numbers, whether it's the one in February, this one in May, or even the ones we get in the summer for the new crop. So you kind of wonder if they really hadn't gone back, taken a look at some of this data here and decided, we really need to make a serious, significant shift in here on our early forecasts. And you tend to see that with them projecting something just short of a 1.9 billion bushel exports. You can relay some of it as being, the changes in South America, but it does look like, as Joe said, really on the demand side where we've made some shifts at this point. And so we've seen new crop numbers, beans and corn both, come in a little bit underneath arguably what the USDA or what the trade was expecting the USDA to say.
Okay, so Dale commented on the scenario here. We're looking at adjustments to demand as opposed to necessarily adjustments on supply, because the supply numbers were, could have been guessed, again, because we're using trendline yields and the March 31 acres numbers. Demand very impressive here on the new crop balance sheets that we'll show you here shortly. But going into the South American numbers, this has been a much talked about storyline for some time now, particularly for soybeans, as we get these numbers come down. But what we're anticipations, there are still, while we see cuts here to the South American numbers, Argentina and Brazil, we don't have, or we still could, in fact, have room to go further lower. I mean, the most aggressive analysts have the Argentine soybean crop cut by maybe up to 15%. And so, Dale, you think we still have room to go yet, and particularly these SAM numbers?
Yeah, the South American numbers are really kind of in play here at this point in time, and the USDA is their want to do on the 15-16 numbers, because that's a crop that we're looking right now down in South America that's done being harvested or yet to be harvested at this point in terms of corn and beans, even in some places. But the Argentine soybean number, the USDA is playing out here at 56.9, and the popular wisdom in the trade seems to be more down to something around 55 million ton. Brazilian soy, the USDA only dropped 1 million ton down to 99 million ton this morning. But this morning, Brazilian, or the USDA counterpart down in Brazil, CONAB, they went from a 99 million ton number down to 96.9. That was the key behind the early strength we had going into the report here today. That was a bigger slice than what people were talking about, and equally so when you look at corn. Not too much disagreement around the world about, the 27 million ton, give or take, Argentine corn number. But the Brazilian number, the USDA stepped down to 81. The Brazilians this morning, they stepped down to 79.9, and they took 4.2 million out of the second crop corn, which is really still fairly early in the growing season down there, and the weather pattern's been dry, so I think their willingness to go that far suggests it may come down a little bit more, and that means the USDA is going to be playing some kind of catch-up. When you look at the South American crops themselves, as far as 16, 17, those haven't even been planted yet, so those are just kind of shots across the bow on what kind of plantings we may see. It is interesting. They are looking at this point, though, for plantings to probably shift. When you look at Argentine corn in 16 to 17 up, and you look at Argentine wheat going to be up in 16, 17, and that will come as a detriment to soybeans. So their soybean number actually could end up being a little high. The rest of them across the board, though, China's corn number being down is basically an acknowledgement that they're going to plant less corn this year. But what kind of crop sizes we see there, and when you look at the Australian wheat crop, the Russian wheat crop, we've got a lot of unknowns. So we'll have to see where we're at going forward on those. So I don't think there's anything really big in those per se to really talk about. Stepping off into the S&D though, and I'll start on this one here with the corn that we've got put up. You can see that, the USDA back in February, they were at 1.977. Of course, we've got a bigger acreage and a bigger crop to work with here. We're going from 13.8 to 14.4, but look at what they did to feed and residual. They added 125. They added 75 back to the ethanol. They added 200 million to corn and on the export side of the equation. And that's really where we came back and said, it kind of looks like at this point in time that maybe they chose to bury some of these changes in terms of smaller crop maybe, or at least acreage shift back into the demand side instead of putting it into the supply side itself.
Yeah, Joe here again, wanting to reiterate these demand changes. You can see the February column here, that's from the annual outlook form from the USDA. Dale, you had just talked to me yesterday about the fact that these February numbers are very rough in comparison to the May numbers, that they pay a lot of attention to detail, and we can see some considerable changes in the demand numbers. And so again, February versus May, that right-hand column, what we got today, we can see that the average farm price paid, there's still a wide range, and that will narrow as we go forward, but the top end, 365 there. We'll go back and point out the second to last number there, ending stocks for May, 2.153 billion bushel. That compares to an average trade estimate of right at around 2.3. So still high, over 2 billion bushels, but lower than anticipated. And yeah, not 2.5. And still in the back of a lot of our heads, we have this idea that acres number can come down. We talked about that at the beginning when the March 31st report comes out, that acres number can come down. And what about yield? Right now we're just using a trend line yield. That number we believe can come down, particularly if we talk about the acres gains that we did have coming in the fringe areas, maybe a little bit lower yield out there weighing on what would normally be a trend line yield. But a lot of growing season yet, of course, and it's on pretty quickly to the production season and related weather. On to the soybean S&D. Really, soybeans having the tremendous fireworks after the report, and that is largely a result of that 305 million bushel number you see at the bottom right-hand corner. That's partially a product, though, of the adjustment in the old crop carryout, of course. We had beginning stocks that came down to 400 million, and that certainly helps out. But similar storyline. We're seeing an aggressive first look at demand, higher crush, higher exports, and that's after the old crop has been adjusted upward in recent reports. Overall, again, that 305 million bushel mark, I'm looking at quotes right now, and it's that number that has July soybeans up 56.25 cents to 10.82 1/4, with the new crop contract up an even 50 cents right now. Dale, comments on the soybeans?
The one thing with beans, the old crop numbers, we moved down to a 400 million carry out there, and we were at 445. And, the problems we had down in Argentina, to a lesser degree, the problems in Brazil really have kind of changed this short-term scenario in the trade around the world as far as where people are going to end up sourcing some beans. And we've had exports for beans out of the U.S. continue on fairly strong for the problems in Argentina, and to a lesser degree in Brazil, and pulled that number down to 400. But the new crop there, they started out at 1.885 million bushel. That's above where they were back in May. And somewhere in the last year, I had in Farm Week and Farm Bureau, or Iowa Farm Bureau spokesman, had talked about how the USDA had consistently over the last 25 years underestimated, in particular, exports out of the U.S. And I had a long discussion with one of the guys at the World Crop Board about this back in January itself, and he said maybe he needed to take a relook at that. And you kind of wonder at this point if, in fact, we may not see them looking at the long history and making an adjustment. And if that's the case, this history we've had in the past number of years of seeing those early carry-out numbers go down as we go through time may actually not work, not pan out this year, unless we really see some serious changes on the production side of the equation going forward. So we may be working with a fairly realistic demand base at this juncture. But in any case, that 305 million bushel number down there, the issue we're dealing with here is that, from a yield standpoint, which they just plugged in their trend of 46.7, at this point we don't have a good feel for yield going forward, other than, we do have good moisture. But just today I got new updates out of Australia about the El Nino La Nina phenomenon, and then they were talking about, again, how fast it's fading, and they said, some of the models suggest that by end of summer be into a mild La Nina at least, and the whole pattern continues to evolve when you look at that particular ocean phenomena, much like what happened in 1983. And for those that don't remember, when rain shut off in June of 1983, they shut off, and we moved into July and August having a real droughty pattern, both heat and moisture both. So, it says we've got to be real careful now, because we start moving down below 300 million on that new crop carryout. If in fact we would start to run into some weather difficulties this year, you're going to find people get real anxious about this. And so it kind of puts the beans on the knife edge going forward. We're no longer in that comfortable scenario, comfortable area as it is. So we got a market that, it's up today, and you kind of wonder at this point, have we temporarily maybe run out of enthusiasm or things that can happen to it to keep the ball rolling uphill? But at this juncture, it says, there's still room for more fireworks later in the summer if weather does develop. In the wheat itself, when you look at the wheat, you're seeing here new crop, we're making that first projection just a little bit over 1 billion bushel right now. The old crop numbers themselves, they didn't really do too many changes there, made some minor tweaking and left things pretty much set in the saddle, and only changed the carryout by 2 million bushel. But that first new crop wheat estimate we had here today, that winter wheat number, they projected one at 1.427 billion bushel. That was about 50 million bushel larger than people expected. The hard red number, 862 million, came in about 50 million above expectation, and that was the real difference there. But it really leaves us saddled with a comfortable supply of wheat here in the U.S., and certainly when you look out into the world, we're still saddled with a comfortable supply there as well. So wheat really needs something else to carry the ball and really make the move. It's hard unless, corn market would really take off and really shift some feed demand away from corn back into wheat to really start to seriously trim the wheat. So it's got to come from there. The other thing that it could come from, when we look at it on a worldwide basis, and it's going to be an issue to monitor, is that from a rice standpoint, we're starting to run into some tightness there around the world, and certainly with the tightness of rice, there is some substitutability there in terms of food around the world itself. So we could see the world scenario change depending on how the rice market unfolds and the corn market unfolds. But the wheat market, wheat prices need something else to really carry the ball and to carry it upwards. Otherwise, the kind of prices we're seeing today are going to really struggle to move up, although nobody's really bearish in the market at this point.
Yeah, time and time again, we've seen that folks aren't going to get too bearish with Chicago wheat trading below 450. We've seen that again and again. And going forward for wheat, it's when do we get competitive again? And that, as Dale mentions, could be something that develops if there's an issue with rice. If the dollar continues to drop lower and provide us a little bit more business here, and there's still some time left before harvest in the winter wheat crop, but right now, that crop's more than 60% good or excellent compared to less than 45% at this time last year. So supply is still burdensome. Can we get a leader out of corn? And the question for corn on what's next here is, where do acres go? In my opinion, we started the spring out questioning the markets because of acres. That high March 31 prospective plantings number of 93.6. They had to use that today. Corn then had some tag-along strength when soybeans started to rally in early April. Just recently, we've had the storyline of a dry Brazil and some crop loss for the second crop and yield loss for the second crop there. Now I think we're back pretty quickly to the acres question, and the next up, of course, that very important June 30th acres report. And then from that point on, of course, we're into the growing season, having questions about how weather's going. Weather for beans has been a bullish motivator for some time. We talk about La Nina, but we'll go back to El Nino and note its influence on the market, first off by rallying the soy oil as a result of those crop losses in Asia for the palm. Traders came over into the soy complex and had picked up soy futures much before they ever turned bullish, of course, on corn. Then we transitioned into less of an El Nino storyline. We knew that El Nino was on its way out and that the Asian palm crop could rebuild. Then it was the RG crop loss story. The fact that up to a third of the crop was severely damaged by flooding. Another third had at least some semblance of quality issues, and we're still seeing that as a factor in the market. And then next we can go back to what will eventually be much talk about La Nina and its potential influence on the growing season late this summer. We have some price charts here, and we'll have Dale talk about some technicals. I am looking for this move in soy to be exhausted at some point. And the reason why, I'll go and address where the fund traders are at this point. And on beans, they have for about 8 weeks now built a very bullish position. They're net long right now by about 175,000 contracts. That was at least coming into today. That number is about 70% of the historical long that they held in 2012. Certainly after today, that's going to be much closer to 100% of that mark. But for corn, we're less than 30% of the long we had just held last summer in 2015. And for wheat, they're still short by about 60,000 contracts. So I think at some point we see a correction likely in the beans, a setback here that brings into consideration some retracement targets. I think up here trading with the front of the curve near $11, we certainly have some pushback, but over on just in general, and we'll address each of these in particular, corn and wheat can hold up better, in part because of where those funds are, wanting to maybe build a position in the grains as we enter production season for corn, as we approach harvest for winter wheat, and then for soybeans, ultimately just take some profit, take some risk off the table for the time being. Dale, your thoughts here on the chart we have in front of us.
Yeah, here we have a little bit different look. This is a weekly chart of November soybeans, and it's all November futures. It's not a typical nearby contract itself because I really wanted to address the new crop, and you can see that you know we ratcheted above the high we had in the November contract back there in early 15, and we're back up against the high that we had back there in 2014, and you can see the same thing even if you go to a typical nearby weekly chart. That had highs on beans at 1060 last year, and then 2 years ago we had a spike high up in there at about 1087, and the May contract and the July contract are both into that. But the move we've had in beans, it's gotten itself up to a level where it's going to be a lot more difficult going higher. You can see eventually, if we even do a 38% retracement, we could move the November up to 12, but for right now, when you look at the beans, you really have to step back from the mix in here and go, in the very short term, what else can I throw at this market that's any more bullish? We've played South America, that's played out. Now we've got a U.S. supply demand that's characterized as being a little bit friendly. So, you really don't have a lot of news or a lot of ingredients maybe to give it a lift, and you've got a lot of short-term technical factors that are just way overdone. There's some pattern structure here that says this is the last gasp of this particular move. So I think we're probably setting up for a pretty good break, and you could easily take the November contract itself, a 38% retracement to take us down a little bit underneath the $10 mark. So for right now, I think these are pretty good numbers. It certainly presented a better selling opportunity than anybody expected at this time of year. And it may not be done if we have weather come into play later in the summer, but I think it's a good point in here that where people dip into the market and get some risk taken off the table. Corn, on the other hand, you can look at this is a continuous December corn futures instead of just a typical continuous weekly futures chart. But you can see that, we have been still playing down in here in this let's say high $3 range in December corn. We've had a lot of support down there across the last year at about $3.50, and we've really not gotten any sustained traction to the upside at this point. But I'd go back and point out that, the low we had back in there in 2014 was a 5.5-year low. And when you step back into some of the shorter term cycles here, the low we had back here in at the beginning of April was a 40-week low, and it looks to me when I look at the daily chart itself that we really have done nothing more than a retest of that low, and that low still has a lot of character of being a real important low at this point. So I think downside risk is kind of limited. Upside potential is still something that's needing to develop, and it may take us some time, but if you do get the market turned at this point, and certainly when you look at the corn-bean ratio, I think there's going to be a lot of people that have been long beans going, you know what, corn probably offers a better risk reward than beans today if I want to play the long side, and so we may see some of that money start to roll over and shift. And I think in the mix in here last year we had a shot at 450 there right at the end of 2014. We had a shot upwards of pretty close to 450, and I think we got a shot somewhere close to that again. So I think in corn, from a risk management standpoint and looking at where we are in terms of the larger cyclic structure, we're down at a point in here where you're really trying to manage your opportunity potential more than you're trying to manage risk. So, I'm being a little proactive, and, we haven't got any new corn sales on the books yet, and part of this is why is where we are in a bigger price structure, in that if corn moves, easily you go to 450, and like beans have a big retracement at 12, the corn we're all the way up there at 521, but it arguably, yes, is going to take weather issues to get us there. But with the speed we've had of the fate of El Nino and the possibility we could drift into a La Nina, I think the market's going to get real sensitive going forward. And as much as people worry about, well, we've got good moisture today, I could say the same thing about 1983. But right now, technically, 350 looks like a good bench of support or anything down near it. If we get over the high we had there in mid-April that was around 410, 415, I think then we probably roll up between 4.25, 4.5, and you can probably start sales in that mix up in there. If you go to wheat, we're just sitting down here on the bottom. We keep playing around the 450 mark. That's the same low we had back in 2010. But like we said with wheat, fundamentally it's got to have something else really carry the ball and make the changes in its S&D structure, whether it comes from the corn supply-demand structure changing and price changing and moving some feed demand from corn over to wheat, or whether it's from rice and food demand, who knows. It is interesting when you look at the bottom we put in back there from the end of 2008 into the middle of 2010. The same period has gone by in this period here from the middle of 2014 out to where we are here. So you kind of think that, wheat's getting poised. And in 2010, for as much as everything else, the corn got the ball game rolling, but all of a sudden we had real weather issues develop over in the Black Sea area, and all of a sudden the wheat just took off and run. So, we aren't totally out of the woods as far as seeing some real production issues come across the mix in here going forward. And I think we'll get opportunities to sell some wheat over 5, but it may be beyond harvest. So we may be in a position where we have to store wheat beyond harvest this year. And if weather problems do develop, you got a shot at 5.5. If that goes, then you could arguably get up somewhere close to 6.5. But the point when you look at it is 4.5 looks like a real good base of support at this point, and really one where, again, like corn, you're really trying to manage your potential opportunity of seeing price improvement, not so much worried about risk of this thing fleshing out to the downside.
Generally speaking, because of the different relationships, again, the soybeans having had that considerable run since the beginning of April, and corn and wheat absolutely lagging behind, that's why we've advocated sales on beans and patience on corn. And we know that a lot of producers have heeded that advice, that they've jumped in with the beans They've caught up on old crop marketing, and they've also taken a stab at new crop sales. And we have advocated that it is a good hedge against your patience. For corn here, what we're talking about with seeing beans bound for a setback is much more of a technical perspective as opposed to a fundamental one. I think overall we're seeing a fundamental shift that's favorable. I mean, just look at the 305 million bushel carryout projection for the next crop year. If we put a dent in yield in any respect, and I think demand will still hold up, then we're looking at something that drifts lower even from there. And we had been looking at folks for even the old crop ending stocks number, those folks looking for continual additions to that, something above 500 million bushels. We never got that. We have a fundamental shift here for the beans driven by the S&D, and we also have a fundamental shift, we think, in the broad commodity space where we have things like oil and metals turning a bottom. We have money rotating into commodities in general and starting to float the space and allow it to climb out of what has been a bear market. That's supportive not just for soybeans but for corn and wheat too. And when you look at a sheet that for corn is just simply not overly bearish, again, not that 2.5 billion bushel ending stocks estimate for the new crop year, then that can be taken as friendly because for a long time we have priced in the negativity related to big stocks here. And so we'll look for a technical setback on the beans, but corn and wheat to hold up relatively better, in part because of the spec interest in the market. We have, again, a net long in corn now of about 60,000 contracts. That can grow as traders want to take more risk as we enter the production season. And in wheat, a net short of about 60,000 contracts, which can be covered awfully quickly if we think we're going to have some strength in corn. So fundamentally, we still have a friendly storyline to tell for soybeans, but a technical one, a perspective that says, hey, the move's been overdone, let's take advantage of it if we do need to make those catch-up old crop sales, or if we're willing to take a stab at new crop marketing like we've advocated. An exciting report, run down prices here. If you don't have them in front of you, we have the July corn contract up 15, December futures at 391, that's up 14. November new crop soybeans up 60 cents. The front of the curve, July soybeans 1091.5, up 65. Again, we'll have to see if we approach that daily trading limit of 70 cents, and also what kind of pushback do we get here if we open up tomorrow and we're close to soybeans at $11. That's all I have. Dale doesn't have anything to add here to wrap up. We will post this online here this afternoon. We apologize again for the technical difficulties at the beginning. We encourage you to send us your feedback and your individual questions to the email you have there, and we'll get back to you as soon as we can. Thanks so much.